Ladies and gentlemen, good day and welcome to Gabriel India Limited's Q2 FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manoj Kolatkar, Managing Director at Gabriel India Limited. Thank you, and over to you, Mr. Kolatkar.
Thank you. Good morning all, and warm welcome to this earnings call of Q2 and H1. So hope all of you had, firstly, all of you had a very good, safe and very happy and joyous Diwali. So we are now, of course, we had both the festivals, Dasra and Diwali, in the month of October. So I must say a bonus month as far as festivities are concerned. So good to see all of you back. Along with me is Rishi Luaruka, our CFO, and Nilesh Jain, our Company Secretary, and our IR advisors, SGA, on the call. So we have uploaded our results and the presentation for the quarter ended 30th September. I hope you have been able to go through the same. So I'll of course take you through the presentation on some of the slides as we go along. But before that, I'll just give a brief industry overview. So top line, of course, we are very happy to report that our growth momentum has been very good, continued in the second quarter, and we had the highest ever sales in a quarter ever. So that's something really significant. If we see, we have been able to accommodate a lot of new product launches during this period, and relatively flawlessly. So we are seeing an improvement as we go along, product launch after product launch in terms of our own maturity of launching the products. So this is helping us, in the time to market part. In the EV market, of course, I'll share that as well. It continues to be a good success story. So in fact, all of our business verticals have exceeded our expectations, resulting in increased volumes. Capacity utilization is in the range of 65 to 70%. In fact, the passenger car, as we speak, is going up even higher. I'll come to that when we probably go through the questions. So coming to the auto industry, yes, the challenges continue. Thankfully and hopefully, the COVID pandemic is behind us now. It's already a thing being declared as an endemic. So that challenge is relatively, I must say, taken care of. But, the semiconductor and supply shortages still continue in the industry. And as we all know, it will still take time. That's what the industry experts say. Commodity prices, the inflation was really severe over the last 2 years. So that clearly has started easing off from the last quarter onwards. And we are seeing prices come off all those highs and coming back to almost pre-COVID levels. You talk about steel, aluminium, copper, every commodity is, we are seeing a reduction that is happening. Of course, this is, as you know, in our case, it's a back-to-back arrangement with the customers. And you all, of course, must have read a recent article on the huge backlog of our waiting list of cars. In fact, if you go to buy any car now, the standard waiting period is 1.5 to 2 months. Some models going, over a year as well for waiting, which shows a very clear, robust pipeline for passenger cars particularly. And of course, yes, there is a bit of cautious optimism there, in the industry as well. I've been speaking to some of the OEMs. They say that once this demand is over, again, this demand, you have to read it with a little bit of pinch of salt, because there is some double booking which happens in this times. But once this demand is over, there might be I'm not telling a slowdown, but definitely we will not see the growth rate that we have witnessed in this first half. As regards the passenger vehicle segment, We had a record month in September, record quarter as well. Clearly, the volumes for passenger car are going to cross 4 million figure for the first time as regards the annual numbers are concerned. There is a very strong response, particularly for the SUV vehicles. As you know, SUVs are over 50% of the sales. So that is a clear shift that has happened in the industry. Infrastructure and real estate are expected to expand, as are also mining, e-commerce, transportation and logistics, which all are very important for economy and for mobility, which is where we come into play. In the coming months, we'll be shaped by the adequate rainfall, which has thankfully again been very good for the country. The first 6 months of the fiscal year, the CV industry grew very strongly at 54%. It has not yet reached the peak in terms of volumes, what we witnessed in 2018-19, which was over 1 million. But if you see in terms of tonnage, it surely has crossed that figure. As you know, the tonnage norms got redefined based on the axle load norms. So if you see the tonnage per tonnage kilometers, I think we have exceeded the earlier figure as far as the industry is concerned. Another growth area has been the three-wheeler segment, which was very dominant, particularly because of, the most impacted segment during COVID, because people were not preferring this mode of transport. The schools were shut, colleges were shut. But this has shown a huge increase in sale in April to September, the first half of the year. Within this, of course, the movement towards EV is even stronger, as we all know, which again I'll share during the slide. Again, talking about EV, the demand for two-wheelers is, really very high. In the month of October, though it's not in H1, but you all know in the month of October, the industry, the two-wheeler industry, EV, sold over 74,000 vehicles. So that's really a huge jump from the earlier 50K peaks that were, which the industry was hitting in August, September. October had a bumper month with over 70,000 two-wheelers in terms of EVs. So here again, as I mentioned, Gabriel has been quite successful in getting all the orders from the key two-wheeler makers. So that has helped us gain market share in the overall two-wheeler segment as well. Coming to the numbers, now I'll take you through the presentation. So I'll just read the slide. If you go to slide number 5, which is the financial highlights Q2 FY23. As you can see, we, like I already mentioned, we did a revenue of 800 plus crores. The first quarter we did 800 plus crores, which is almost a 36% jump year on year. And even if you see sequentially, 802 crores would be about 10-11% compared to the previous quarter, which was also a record quarter, which was 720 crores, which you can see below. In terms of EBITDA, we did 59 crores, which is 7.4%. So, marginal improvement in EBITDA from, as you can see below Q4, the last couple of quarters, from 5.5 to 7.1 to 7.4. So our efforts on, cost reductions and Core 90, which I already mentioned earlier on several calls, those are working. And similarly in PBT, you see pretty much the same improvement of 36-37%, YOY. Coming to slide number 7, is the financial highlights for the first half, H1. So we crossed 1,500 crores, so 1,524 crores in sale. Needless to say, highest ever. EBITDA of almost 110 crores, PBT of 94 crores. The balance sheet position also is good, net cash of 251 crores, and we had in H1 we had cash flow from operations of almost 25 crores, which was a little less than the last year's corresponding period. But in the quarter, if you see, we had a much better cash flow compared to the last quarter. Capex, we incurred almost 47 crores of capex in this year, mainly on R&D and capacity improvements and quality and safety improvements that we have done all across our plants. Slide number 8 is the very quick P&L. So I'll not go through the detailed figures because I already shared that. We'll move to slide 9, which shows the trend. As you can see, FY23 half-year sale is 1523 crores, which is more than the full-year sale of FY17. So a good growth, good gain in market share in all segments that Gabriel has achieved has led to this this good improvement in the sales figures. ROC for the quarter again has been really good, almost 34%. So again, based on our good efforts by all the teams, and Rishi, who is on the call, I think this we have achieved quite well. On slide 12 are the key ratios. While again, I'll not go through each of the ratios, but we also know that we declared the interim dividend of 90 paisa yesterday in our board meeting. So this is again something which is definitely in line with what we have been planning to do. Coming to slide number 14, which is the segment performance. Two-wheelers and three-wheelers, this is including aftermarket. So the market share here, of course, is the OEM market share. So you can see, while 65% of our total revenues comes from two-wheelers, the market share is 32%. This is including EV. Just to share that the same slide last year, which was the half-yearly call which we had in November of 2021, this figure of market share was, so you can see a very healthy improvement in market share, mainly on the back of the EV dominant position. We continue to get good models. Recent launches being the TVS Raider, which is very successful, Jupiter 125, Mahindra, all the platforms of ESD and Java, and Bajaj. These are three-wheeler models, and EV. Ola, Ampere, Ather, Okinawa. We also got an order from Hero Electric, which is the only one which we didn't have. We also got that order, and the SOP will begin in the next quarter. Coming to slide 15, which is an EV. So our share of business in EV is 66%. So the industry figure was 32%, as we saw in the previous slide, but the EV share of business is 66%, which is, and you can see the models, so Okinawa, Ampere, Ola, Ather, TVS iQube, we are there on all these industry leaders except Hero, so that augurs well for us for sure. Coming to passenger car, again this has been a good performance. The market share is 23%. The same figure exactly 1 year back was 21%. So we again marginally improved. Mainly on our increased share of business from Maruti Suzuki and the Toyota platform. So Maruti Suzuki, we have won the what we have written here is YXA YSG, which is basically the Grand the Vitara Brezza and the Toyota Hyryder. So these are the two key volumes, and in pipeline is YWD and of course the Y0M, which is new Alto, has already been introduced. YWD is the Jimny, which is shortly going to be launched. We also have started the Stellantis or the Peugeot Citroën CC21, CC3 as well, which has been received quite well at the market. The volumes are small, but it's a good car, I must say. Quite a spacious, roomy, and a good value for money for that price point. That is fine. So still on slide 16, which is the passenger car. So yeah, we also have already got the business from Volkswagen and Skoda for all the new vehicles that you see currently, right from Slavia to Virtus to Kushaq and Taigun. So that is entirely with Gabriel. So this will of course keep adding to as the volumes ramp up. This will add to the passenger car sales as well. Going to slide 17. The slide 17 commercial vehicles. So here of course we are the dominant market share, almost 90%. all the new platforms, almost all OEMs are with us. We continue to work on some new technologies here as well, so that we are able to, answer all the future requirements very well. Our exports program in DAF is also going quite well. We are already exporting to Netherlands and Brazil, and we have won some more programs from them as well. And in fact, recently we had the Pakar DAF vendor meet, the annual vendor meet, where we were asked to present to the entire fraternity on the success story of Gabriel. So we already have won the award from them as the best new supplier, and also top quality supplier, which they have an award called 10 ppm supplier. So we have won that as well. This augurs well for our exports, and we surely want to leverage this in terms of our global journey in CV particularly. The next slide 18, is on railways. So as you can see, a lot of new pictures here, new models for us. So we have got at least the first breakthrough for the Vande Bharat Express. We'll be supplying to Medha, who got the orders for the rakes from the government. So we are also talking to some other rake manufacturers. So discussions are on. And another important thing is we have been developing and working on the locomotive dampers, which Gabriel was never supplying. So we have again got the first development proto order, and we have actually supplied our parts for tryout to the locomotive works. So this will also increase our presence in the railways. Having said that, yes, the volumes are still small for railways. They have still not recovered fully to pre-COVID volumes. So we'll have to wait and watch this particular segment. But yes, our product portfolio has definitely increased, or the content for railways, if I may call it, has definitely increased as regards railways. Coming to next slide, which is slide 19, aftermarket. Again, very strong growth, 24% growth on H1, and in fact we have hit almost 100 crore figure in a quarter, in this last quarter for sales of aftermarket. So a lot of new product launches, that has been, and we are trying to reduce the time to market. We are increasing our traded products or the branded products that we have. Tires, while we had launched it earlier, we had some challenges, so we are now renewing the push on tires, and we surely expect this to increase quite well going forward. The initial response has been good with the new launches that we have made in tires particularly. Slide 20 is the exports. As you can see, this has been, while the story was good and we are on the right track for the entire last year, I would say post-COVID, but then due to the Ukraine conflict that is going on, Volkswagen has almost closed down the operations there, so which has a significant impact on us, because we were supplying on a single source basis to Volkswagen Russia for the rear dampers. That decision is yet to be taken. What we hear is they are likely to shift this production to a different country, but till that time, yes, this volume has gone out from our figures. But despite that, you can see from Q4, Q1, where we were doing 21-22 crores of quarterly sales, we have still improved it in Q2 to 25 crores, based largely on the increased orders from DAF of Netherlands. 21 is the balance sheet. Again, I'll not. I already shared the broad numbers, which is 251 crores of cash at the end of September, and capex of 46 crores that we have done. We have also lined up some new capex for increasing capacities. This is Hosur, where we are doing the in-house manufacturing. It's actually a backward integration where we'll reduce dependency on our imports from China, which has been a continuous initiative for us. Chakan for capacity expansion, because the Toyota Hyryder and the Vitara Brezza both are being supplied from Chakan, and the Volkswagen as well. So because of this, there is a good increase in demand in Chakan. Deva's paint line is an improvement. The paint line was very old, so we are having quality and safety issues. So this was a planned decision. So this is on stream now. A new high-tech paint line with much better efficiencies and quality. Khandsa again expansion due to really good volumes of Maruti Suzuki. In addition to our own increase in the share of business with regard to Maruti. So both these together. This we had started last year itself. We are actually coming to the. We'll probably come to the close of the capacity expansion. We are also putting up adding a building for which of course we have to take the relevant permission. So that is on stream. Cash flows again. I'll not spend time on this. The Core 90, which is slide 23. Why I'm mentioning this slide is this has definitely helped us, and you're seeing the results. We continue to push. We are reviving it again. It's always there, but we are again pushing so that we make the most of the improved commodity scenario and try to improve our margins further. So this is the slide 24 is a vision, and going forward is the corporate overview, where you can see on slide 25 the picture of our new tech center in Chakan, absolutely state-of-the-art tech center. So this will also help us in our journey in improving our positioning with customers. So this is, in short, a quick, run through our numbers based on the presentation that we have uploaded on the site. So now I'll end my presentation. And just one more thing is the sustainability report. We have been as a company and as a group very focused on sustainability right from inception. To be honest, we have also won several awards in the industry within the auto composite industry. Yes, we are known to be doing very well on this front and the human resource practices, as you all know. So I'm very happy to share with you that we'll be launching our first ESG report very soon. In fact, in the next week, it is ready. But I thought I'll take this opportunity to share with all of you that we'll be launching the first sustainability report for 21-22, and from next year it will be along with the annual report itself. So with that, I hand over back to the moderator and look forward to your questions and your inputs. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question at this time may press star and then 1 on their touchtone telephones. If your questions are answered, you may withdraw yourself from the question queue by pressing star and then 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. Our first question is from the line of Viraj from SIMPL. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on a good set of numbers in such a challenging environment. Just have a couple of questions. First is on the cost part. So we have been for last many years undertaking Core 90 program, and I think the benefits of it we have been clearly seeing in last few quarters. So just kind of dwelling a little deeper into this, because when you look at the OPEX cost and at the reported level, we have this management service fee, which I'm assuming is kind of a portion across the 4 quarters. So when we're to kind of adjust for that, how would have our break-even cost moved in last few quarters, as a benefit of Core 90? So any deeper if we can dwell into, and incrementally what kind of a savings one can expect further, from this program?
Thanks, Viraj. So, we have been working. We track the break-even point, and the break-even point has been reducing. So the absolute break-even point, of course, has gone up due to higher volumes and higher costs, and there are some conscious investments that we have to do as we move to the next level of revenues. That definitely adds some cost. But however, the break-even point in terms of percentage of sales has been continuously reducing. That's how you see the improvement in the margins that you have seen over the last couple of quarters. So that remains a focus area. Now, your second question of how much we can expect more from this cost reduction. It's a game which is you have to play to survive in this industry. While as you know, the OEMs also have not passed the entire price increase to the market. They have absorbed some of the commodity increases to the market, which is why you are seeing such a good demand as well. So they have absorbed. So in terms when the reduction scenario starts, while we have to pass them on, there is a continuous pressure from them to pass on reductions due to volume increases. So that continuously goes on. So you have to keep running twice as hard to stay in the same place, as we say. So that continues, but definitely Core 90 has sensitized the entire team towards cost. That is a good part. So we are better prepared in case of when things do not go as planned.
So just two follow-ups on this. One is, in the past we used to talk about the break-even being around, say, plus 70 to 75%, and I think in one of the last calls got it down to below 68, 67, and this was a couple of quarters back. So if I have to just understand in current perspective, would it be still around those levels, or we have managed to further bring it down to, say, probably somewhere between 60, 65, those kind of levels? Just a perspective, if you can share, maybe not the exact figures.
Yeah, we've been able to down from 68% levels, surely. So, I would say a couple of percentage points, yes.
Okay, and second part to the question was that, as volumes further improve, just trying to understand, the cost base which we are looking at right now, and we have been kind of maintaining this kind of a cost base for quite some time. So what kind of a scale this cost base kind of can cater to, if I have to look at next 2-3 years, and beyond which we would have to kind of look at significantly increasing the investments, or, just to kind of give a perspective in terms of, what kind of a cost base, what kind of a turnover this cost base can cater to.
Yeah, so in terms of, I would say, maybe slightly rephrase your question, and I would say that, there will be some cost that we'll add to be ahead of the industry, or at least, even be in some cases in line with the industry as regards technology. So we have already shared, in terms of having a dedicated technology team. We have already added our CTO who's an expat. We are adding a couple of people more there. In fact, we'll add them in Europe and back end here in India as well. So these will be some additional investment that we'll do in terms of ensuring that technology is in place for the future development of suspension. So these are costs that we'll have to add. Also, yes, we have to add some. While we've had a good land bank, we still have a good land bank. We have to add some more greenfield locations now going forward, because up to 3,000 crores, like I had mentioned in the earlier call also some years back possibly, we'll have to look at addition of buildings, even in new spaces. So we will be definitely adding a footprint in South to meet the increased volumes of two-wheelers, EV, and also improve our backward integration. One dedicated initiative that we have taken is reduce dependence on imports, mainly, as you know, from China, mostly from an angle of one, geopolitical uncertainty, and second, also from being more flexible, and third, being more cost competitive. So these are some investments that we'll have to do that will add to the cost, if that answers your question.
Okay. So, the reason why I was asking is, in last couple of years, we've kind of also made a significant investment. So we have opened few more R&D centers, we have added some, we've kind of bridged some roles at the senior level. So in that perspective, despite those investments, we have kind of able to maintain the cost base quite well. And hence I was kind of trying to understand in relation to the current cost base, what is the kind of scale one can kind of cater to without before going into a major next level of investment. So that was a whole thought process. Second question is in relation to, you mentioned about greenfield investments, which we are looking to cater to. So when you kind of looking at setting up a greenfield, what is the kind of commitments or communication you are getting from your customers? If you can just kind of give a more deeper dive, which segments these are in, which we are seeing a demand accruing, and hence we are kind of looking at greenfield investments per se. So that is second. And third is any update you can give on the new venture or the new product which we were kind of evaluating. I think it's been more than a year and a half. So any perspective you can give on those points. Thank you.
So quite a few questions. So on the greenfield, I'll tell that the customer volumes. We can't double guess the customer. We are seeing clearly there has been a very solid growth quarter after quarter. So we'll have to be in line with that. We do our own factoring of volumes of course each customers, but then we are still clearly seeing a growth. And as I said, part of it is customer driven, part of it is our own intent to integrate backwards. So reduce our cost base. So greenfield is a mix of both. The other part was on the new product, I would take it on a larger level, which is inorganic growth. So yes, we are as we speak, in discussions on I would say a couple of projects, but obviously I cannot share as of now because they are still in discussions.
For new product, I meant more from a sensor. I think that was one of the products we were evaluating.
Yeah, so sensor is a product we are evaluating. Again, we've done the complete detailed study. So we had even applied for the PLI benefits there. So so that is one of the commodities. So the detailed scanning is done in terms of who are all the players who can give us technology. But yes, it is still in early stages.
Sure, I'll come back in queue. Thank you.
Okay.
Thank you very much. Ladies and gentlemen, before we take the next question, we'd like to request participants to please limit their questions to 2 so that the management is able to address all questions. Our next question is from the line of Deep Shah from Yes Securities. Please go ahead.
Thank you for the question, sir. And so a couple of questions. First is on the market share gains mentioned into the PPTs for two-wheeler segment. It was at about 2%, if I'm not wrong, sequentially to 32%. And similarly for CVs also, it is at about 4%. So first of all, what explains this and whether these are sustainable expansion?
Yes, Mr. Shah, definitely sustainable because we have made some, as I said, in the EV space is helping us. Their volumes are increasing as you see month on month. The growth is 300% in EVs, and it will only keep going up. So there we will continue to increase our market share totally. Now, having said that, yes, maintaining this kind of share of business in EV will not be easy. Certainly, there will be other people vying for this space, as well as OEMs will be looking at alternatives. So that will go on as a process. But on a trend line, yes, this market share improvement can continue. Even with legacy customers, let's say TVS, we have improved our market share. With HMSI, it has improved marginally, but with the introduction of this new motorcycle which they are planning, where we have got the 100% share of business. So it's a first motorcycle entry actually. So this will improve our share of business with HMSI further. Similarly, if you see on PC side, Maruti Suzuki, we are getting more and more models. Tata Motors, we have got one model, and we are just last week we have got a confirmation for another model. So where our presence was quite low, so that's why it's significant. So we are gaining there also. And I mentioned on Volkswagen, we were under development. Now all the products are developed and cleared, and we already started production, but each and every model will start getting productionized now. With all this, clearly I see the market share improvement will surely continue.
Okay. Sure, thanks. And second question was on this backward integration capex, which you have been talking about. So if you can talk more on how things will shape up, let's say on the cost savings front, because we are talking about localizing the component as from China. So on sustained basis, do you see this would add at least 40 to 50 basis points to our margins?
Yes, that's an interesting question. See, there are multifaceted reasons as to why we've done the localization and why we continue to do some amount of insourcing rather than actually buying. A couple of things. One is largely also driven by the customer's requirement on some of the strategic processes to be done in-house. The other is obviously to streamline the supply chain and reduce the dependency because of the higher lead time that we have seen. The third aspect is with regards to cost. Cost is something that, while obviously when we take the decision, it's beneficial to us, and a project like Nest, that's what we mentioned in the capacity, in the capex slide as well, is significantly going to help us in terms of sort of improving our raw material costs. But over a long period of time, these initiatives are largely driven towards maintaining a steady state of supply to the customer and also to reduce dependencies where there are processes which are critical to the product. So in terms of benefit overall, the way we look at it from there, in one way or the other, there would be another compensation for this. So not very clear to sort of comment on your 0.5 at this moment. But the endeavor is definitely for each of these projects to ensure that there is a reasonable payback and the hurdle rate of IRR is also taken care of.
So just to follow up, what is this particular stuff for backward integration?
Well, we keep adding. We had done almost, if you ask me, we had done almost 20 crores already in terms of increasing our adding furnaces and machining centers to. The biggest commodity that we buy is the aluminum front fork outer tubes from China. Now, let me also tell that they are really absolutely efficient and real top quality. It's really difficult to even find a supplier in India who can give that quality, that quantity at that price. So that is why we took this decision of making it in-house. So we have done investment. We are further increasing the capacity by adding one more furnace, which got approved just in yesterday's board meeting. So we will continue to do that. So like I mentioned, and Rishi also mentioned, China is, as we all know, really competitive. So it's not that by doing that we'll immediately save some big amount of money. It's not like the localization from Japan or the developed countries where we have 20-30% margins. So that is the difference. But also, let me tell you, there is an improvement. We obviously get some benefit, and the bigger benefit is in terms of the flexibility. So if you know, not last year, but after COVID, when there was a steep recovery, we had incurred a freight bill of almost 12 to 15 crores in the year, just to secure supplies from China. Of course, there were COVID factors, container factors, shipping not available, etc. But now here, I hardly got a call from any customer during Diwali, even during these high volumes, which clearly means that the supply chain is far more streamlined. It's a much more smoother supplies, which improves our customer goodwill, improves cost. No doubt, we don't incur these costs and reduces a lot of stress, unnecessary stress in the system.
Sure, sir. Thank you.
Thank you. Our next question is from the line of Chetan Ginodia from AlfAccurate Advisors. Please go ahead.
Hello, sir, and congratulations for a great set of numbers. Sir, I had two questions. Firstly, if I see two-wheeler and passenger vehicle volumes on a quarter-on-quarter basis, they have grown by 14 to 16%. Whereas our revenues have grown by 10 to 11% on quarter-on-quarter basis. So has there been any realization decline that we are seeing that we have passed on, and is it now entirely complete? If you can explain this.
Sorry, Chetan, did you say our revenues have I probably lost you on that. Revenues have declined.
Revenues have grown by 10% quarter on quarter.
Yeah. Yeah, 11%. Yeah, that's right. And
yes, versus PV and two-wheeler industry growing 216% on quarter basis. So, is there a realization decline?
No, I wouldn't think so. In fact, if you the figures that we have in terms of volumes of the industry, let's say in passenger car or CV or two-wheeler, three-wheeler customers, we clearly see. I mean, our growth has been ahead of the industry. So maybe we need to.
Got it, sir. And secondly,
but we'll come back to you on that.
Okay. So secondly, we have multiple new models. We are part of multiple new models in the PV segment, and also increasing our share of business with Maruti. So when can we see our market share improvement in the passenger vehicle side, similar to what we are seeing on the two-wheeler side?
Yeah. So as I mentioned, we have already seen an improvement from 21% to 23% in passenger cars. I'm talking of year. I mean, same presentation last year versus this year. Now in two-wheelers, the good point of the blessing that we had was the EV, the change in the dynamics of the market because of the EV players, and many of them being non-traditional, not aligned to any particular shock absorber maker. That played to our advantage. Where they wanted definitely a good, reliable brand name with a lot of flexibility in development. That's where we could win business. That happened in two-wheelers and three-wheelers. But in passenger car, in the EV space, that we are not seeing that kind of a huge volume. So obviously, while our market share will improve from 23% to, we definitely targeted higher than that, much higher than that. But it won't be in the same pace as two-wheelers due to, as I said, the dynamics in the market.
Okay, got it, sir. Thank you and all the best.
Yeah, thank you.
Thank you. Our next question is from the line of Akshat Haria from Multi-Act PMS. Please go ahead.
Yeah, hi sir. Thank you for the opportunity and congratulations on record high sales numbers. I had just one question mainly on margins. So if you look at it, we've seen significant improvement in our cost structure below the gross margin level, and that is what has led to our recovery in EBITDA. However, if we look at the raw material cost or the cost above gross margin level, what we see is that the raw material cost, which used to be around 71-72%, up until 2018-19, now since last few years has been in the range of above 75-76%. In fact, this quarter also we've seen a sequential increase from 76.5 to 77%. So, and at the same time we've increased our market share. So, any such indication that the increased market share is coming at the cost of lower realization or something like that, or when do we think about going back to our historical 71-72% RMC?
Yeah, Akshat, good observation. On the raw material, as we all know, the commodity cycle was continuously increasing, so that definitely increased the percentage. So once these commodities are coming down, we'll see some marginal correction, but honestly, going back to 72% is difficult because again, this is the way the market is moving, and we have to compete finally. But what we need to do in terms of improving our raw material percentages, try to maximize on aftermarket and on exports. So that's what we are trying to do, so that at least balance out the market pressures. So that's why we are seeing that push in terms of aftermarket, in terms of exports. So that's and yes, getting new technology products. So that's why the push on technology as well, where eventually we'll be able to reset the may not be the raw material, but overall profitability base, we'll be able to reset it at a higher level when you introduce new technology products.
Understood, sir. And sir, overall on the EBITDA, our target of double-digit EBITDA margins, are we on track? And what could be the timeline or a glide path towards that 10% EBITDA margin? Because still, we are like almost 2.5-2.6% away from our target range. So the glide path could be mainly through RM cost or even further efficiencies below our gross margin level. And also, if you could give the thought process on management fee and any feedback on the feedback which we got on the last many calls. So any thought process on that from the management side? Yeah.
Yeah. So EBITDA, 10%. It's very difficult. I really cannot give you a guidance going forward. But we clearly are focusing towards getting to double digits. It is getting more and more difficult, to be honest, as we go along. With every change in the marketplace, we are seeing this is becoming all the more difficult. So really difficult to define a timeline when it will happen. But we had earlier thought about 2025, but then COVID took away 2 years. The whole thing got reset. So we have to rework on that number of getting back to 10%. That's what I think I can share on this.
Sir, any reward from the board or the management on the management fee suggestion which we've received in last many calls?
Well, except on the management fee, we've explained in the previous call as well. These are towards expenditures which are incurred by the Anand Corporate towards the various services, plus the brand for which we are able to realize the profitability from. And also we've done the benchmark transfer pricing study on the same as well, and we have found that in line with it. This also, as you might be aware, gets tested in the income tax assessment as well. So from that perspective, we are in line to the principle as well as the percentage that is being given on this. Yes, there are some thoughts and discussions of looking at the model going forward, given the increase in scale and volume. But yes, we have to still see that volume on a budget or a strategy number for us to look at the model. So as of now, we would like to continue with the current model.
Thanks a lot, sir. Thank you.
Thank you. Ladies and gentlemen, please limit your questions to 2 so that the management can address all questions. Our next question is from the line of Dhiral Shah from Phillip Capital. Please go ahead.
Yeah, good afternoon, sir. Thanks for the opportunity. Sir, on the export side, what is our outlook considering the global slowdown and all?
Well, Dheeraj, fortunately for us, DAF is really doing very well. They in fact introduced 2 models which won the Truck of the Year award, and I'm proud to say on both of which Gabriel has been supplying. So that way, DAF story is very strong. And the slowdown that we are seeing, of course, is mainly on the passenger car side, which we are currently not supplying. Commercial vehicle is still going quite strong, and the issue, as I said, Volkswagen Russia, which I mentioned, once they decide to shift it to another location, that actually will restart. So while it is a temporary setback, but going forward, I see that as an upside.
Okay, and sir, how much we are backward integrated as of now, and with the new capex that we are talking about, how much this will improve the ratio overall?
Well, in terms of aluminum castings, we still do buy a lot from outside sources, but we have close to half of it we have already done. Plus machining as well, we have done even more. Powder coating also we have installed. So that is done. This is the main component in 2-wheelers. Coming to passenger car side, we do the piston rods in-house with very green and top of the line technology. So that that is again a main component. We do, I don't have the figures as such, how much of, on a overall, because it's a mix. Model-wise, we sometimes do a make versus buy, even model-wise. So at gross level, if you want me to answer, what would be our backward integration or what is the buy that we do, well, I don't have that figure, but we can definitely revert back to you.
Okay, sure. And sir, lastly, on the aftermarket side, what is our strategy to accelerate the overall growth?
Couple of things. One is, we are continuing to increase our penetration, and we are done in tier 2, tier 3 cities, but we are taking it much deeper, and also trying to penetrate areas like northeast, which we can do more. That is one. Second, we have a very successful program called the Elite Retailer Program, which we do in India. So now we have launched that in Nepal as well, and we plan to do that in the subcontinent, which connects us to the retailer, who actually is the main person who can make a big change as far as sales is concerned. So this is the second part. Third part is, as I said, tires, which we see as a good potential in terms of sales. That we had our own challenges where we had to change the supplier as well, based on quality reasons, quality and capacity. So we have done that, and the response has been really quite good. So with this, we'll be able to increase our new product push through tires. We continue to add new products. We already done in terms of the three-wheeler cone set. In terms of, we have also looking at drive shafts, and we are already doing the radiator coolant and the front fork oil, etc. So that is already in place. We also added the brake pads last 2 years back. The passenger car brake pads as well. So with this, aftermarket should definitely improve. In addition, we have formed a task force internally to improve our time to market and to introduce more and more products in the market. So that is also fallen in place. That's why you see that we have been able to actually record quite good numbers, a good growth, and as I mentioned, a sale of almost just a little less than 100 crore in a quarter.
So can we expect, sir, this run rate going ahead?
Pardon?
Can we expect this run rate of 100 crore or even more than that going ahead also?
Yeah, I would say yes. I also forgot to mention, we have also added our dedicated exports manager in the aftermarket team. So where next year we want to push the aftermarket sale as well. So even that addition we have done.
Okay, sure. Thank you so much, sir.
Thank you. Our next question is from the line of Jyoti Singh from Arihant Capital Markets. Please go ahead.
Yeah, thank you for the opportunity and congratulations on the good set of numbers. So, sir, my question is on the EV side, that how much percentage we are going to expect that we will grow. And another question on the competitor side, like we are in the smart lock and keyless. So, like, how we are expecting it will grow ahead. And last thing that I'm trying to connect with the management from the long time, but I'm not able to. So if you can help me in that also.
Okay. Thank you. You said your name was Jyoti?
Yes.
Okay. Yeah, Jyoti. So we noted your last point. We'll request SGA also to try to get that connect done. On the other part, we lost you in between. I couldn't hear you, but I'll just mention on the first part which you asked about the EV and the competition and the growth. So it's growing. I mean, as you know, April, May, June, it was at 50,000. I'm talking about two-wheelers, which is the main segment that is moving in EV space in good numbers. That has gone to 70,000 in October. The schedules that we have got in October, November also are good, and that growth rate will continue. I mean, obviously, the penetration of EVs is still only 4% compared to the industry, but it is improving. Last year, it's gone to almost 6%. Last year, same time, I think it was about 2%. So from 2%, it's gone to 6% in two-wheelers. In three-wheelers, it is higher. So the growth rate for sure for next 2-3 years in EV will be very strong. I don't see an issue with that. In passenger cars, yes, as long as the OEMs are able to bring cost competitive models, this growth rate may not happen that quickly, like it is happening in two-wheelers. There is range anxiety as well. We are reading several reports on the claimed range versus actual range due to terrain, driving conditions is very different. So on passenger car, while the growth we are seeing, but we may have to be a little more watchful. But two-wheeler, three-wheeler, for sure, it will continue to grow very well.
Ms. Singh?
Yeah, and sir, on the competition side, how we are competing in the market on the we are in the smart key and keyless segment. So there are a number of companies whoever is providing to OEMs. So how we are differentiating from that and how we are competing?
Sorry, but this is what I could not listen. We lost you for that. But on the car key and smartless, we are not playing in that segment, so we don't have any offering in that segment. I mean, that product.
Okay, thank you.
Thank you. Our next question is from the line of Jayesh Gandhi from Harshad Gandhi Securities. Please go ahead.
So congratulations on a good set of numbers, and thank you for providing me an opportunity. So my first question is, in the context of PLI that we have applied for, what is the status? And can you just help me out in understanding the opportunity in the sensors which we have applied in PLI?
Just thanks for the question. So essentially, the step towards this PLI application was done along with the Anand Group of all companies for the purpose of being able to qualify the various criteria which was there. We have applied under the sensor category. This project evaluation is complete in terms of the market space study, also the current customers and the way the supply chain as well as the current production is being done. We are looking at the domestic sensor space only at the point in time. The way it currently stands is that the technology partners are being evaluated in terms of who to sort of evaluate for further discussion. Post which we will start looking at the numbers because again in sensors there are various categories and we are yet to decide as to which one we would like to foray into eventually. So it's currently a little fluid in that space, but as and when the plan progresses, we'll be happy to announce on that.
And so what is the investment that we have applied for in that PLI?
So PLI overall investment would be in the range of 40 to 50 crores over a period of 2 years of time. But that will all depend upon what kind of manufacturing footprint as well as template we acquire.
Okay. And sir, last question on railways opportunity. I think we have got a breakthrough in Vande Bharat from Medha, I guess. Can you just throw some light on the opportunity size here? I mean, what can be the sales potential? I mean, that you are looking in next, say, for 2-3 years?
Well, sales potential wise, it still is a small part, but the point is, the LHB coaches which we have seen is moving to this, Vande Bharat. So earlier it moved from the old bogies to LHB. From there we are seeing a shift to, the Vande Bharat trains. So we are seeing an improvement, but the volume should still be very, very muted, I must say.
Okay, that's all from my side, sir. Best of luck for future.
Thank you. Our next question is from the line of Pankaj from Affluent Assets. Please go ahead.
Thanks a lot for taking my question and congrats for excellent set of numbers. Sir, just wanted to understand, we have been claiming to have a successful cost control measures taken over last 3 to 4 years, but our margins are still 7 odd %. So are we in any kind of commodity product? Because since I track some other companies or competitors of ours who are enjoying upwards of 10% margins, and in our in a question earlier by earlier participant, you were quite diffident in saying that it will be difficult for you to give a timeline to reach that double-digit margin mark. So just wanted to understand, since we are into right suspension quality product, why are we not able to defend our margins or claim better margins given the 7 odd % of margins we have been charging historically?
Yeah, Pankaj, so good question. So it's not exactly a commodity market, but yes, there are several players in the market, so that there's a fierce competition from what it was earlier. So as you know, in the last couple of years, several players have got added in the fray, so that makes it that much tougher for everybody, surely. It is not a commodity product because OEMs still value this product and also give a lot of importance to the ride and handling, particularly the global OEMs. So I don't think this falls in the commodity space. The market pressures are there, and your point about other players being in a higher margins, actually, of course, there are some in competition who are in listed space where we have the figures. They also are a group of companies. So ascribing that entire margin to this particular product, I don't think would be right. We don't know because it's competition and not that data is not shared. But yes, there is for sure room for improving margins, definitely. So I think I can only share this much with you.
Despite our success in the cost-saving measures, we are still there. Secondly, I suppose this is the first time you have introduced a full-fledged slide on railways. So, and do we see substantial portion of share going forward coming from railways, and are they at better margins, or that would be a tender business?
Yeah, so Pankaj, the margin is definitely much better than the others, no question. But the volumes are really, as I mentioned, very insignificant. This Vande Bharat also, the orders that we have is just a couple of crores, so it will take time. And even, you also mentioned it's a tender business. That's right. So it's a tender business, so it gets shared between 4 or 5 players. As of now, there are lesser players, but they have a policy where a new player gets a 20% order as a development supplier. So yeah, it is always, you can't expect a higher share. It is distributed. Margins are good, but revenues are small. So they definitely help in the margin front, not in the top line front.
Okay, but I understand that there are orders of around 400 odd Vande Bharat trains. And are we not present in metro segment?
No, we are not.
Also would require.
We are not there in metro. So we have been in talks with Bombardier and Alstom. So that needs a different product. But right now, yes, we are not in metro business.
And as there are 400 orders of 400 odd Vande Bharat trains, and
yeah.
Are we getting only minuscule share of the whole?
No, it's only a start now. Once we get into C, we normally operate on a 20-25% share.
So what is the potential that we can reach?
in terms of railways.
Yes.
Well, if you see the total revenue now that our revenues is, let's say, first half we did 1,500 crores. So railways would be, a very minuscule portion. I mean, just about a few percentage points, very low single digits.
Right. So what is the potential then? Can it contribute meaningfully to our share of revenues?
No, honestly, no, because this is a completely tendered business. I mean, whatever we do, even if we are much better facilities, much better R&D, we have to compete with a supplier who's I mean, what do you say? I wouldn't even consider him as a tier 2 supplier. So that's the way the business is.
Okay. Thank you. Thanks a lot, sir.
Thank you. Our next question is from the line of Viraj from SIMPL. Please go ahead.
Yeah, thanks for the opportunity. Just two questions. First is on the capex for this year and next year. If you can just guide, what is the capex we're looking to spend?
Whereas it should be in the range of 120 to 150 odd crores.
For both the years put together, or you're talking about each of the years?
Each of the years.
Sorry, your voice was breaking.
Each of the year, Viraj.
Okay, got it. And second is on the export piece. So you said that despite VW being not there, we're still kind of doing around 25 odd crores kind of a run rate. With the new orders, how should one understand the export, roadmap for us for next few years?
So the immediate target is, of course, crossing the 100 crores. That would be for the year. I mean, going forward now, we are seeing some good interest at least generated due to the China factor. As you know, the China plus one strategy. So there are some people who are re-looking at resourcing the China imports or China buy. So yes, it will take time. I mean, we don't have an order which we can say yes, we have got it. So the SOP is so and so, but we clearly see this materializing into good orders. Let's say from 25 onwards.
Okay. And last question is on the margin and especially the contribution margins. So, if I look at our own history, we are at the lower end of the historical band in the contribution margins. Now, I understand there was an impact in terms of raw material pressures and other factors. But, if I have to look at going forward, your communication seems to be that even close to double-digit margins, looks a little difficult. So is it that the new borders which we have kind of won, are they at a much more aggressive, price points, and hence the margins which we typically on those segments are, won't be enjoyed in the future? Is that how one should understand?
Yeah, Viraj, the honest answer is yes. The margins are under pressure. It's not only for Gabriel. This is the overall set of numbers. You can actually do a check on the overall industry as well.
Okay, but in terms of major segments which we have won the orders, say in case of EV two-wheelers or passenger cars, passenger vehicles, new orders, the base margin in that business is not moderated materially, right? Or has that been the case?
So EV we are seeing better margins, of course, as of now. But yes, once they are under market pressures, things will flow back to the suppliers. But as of now, EVs we are getting it at relatively better margins.
Okay, fine. Thank you very much. Good luck.
Thanks, Viraj. Thank you.
Thank you. Our last question is from the line of Dhiral Shah from Phillip Capital. Please go ahead.
Yeah, thanks for the follow-up opportunity, sir. Sir, does content per vehicle in EV is better than the IC on the two-wheeler and three-wheeler side?
Well, Dheeraj, content is the same, but our realization is, realization and margins are a little better. Content is pretty much the same.
So if you can quantify how much realization better?
Sorry, Dheeraj, I can't do that.
Okay, at least 10%, sir, not more than that?
Well,
No, Dheeraj, unfortunately, that's the information that would be counterproductive for us, so we would not like to share that.
Okay. And so lastly, if you can, bifurcate your CapEx, how much for, capacity increment, how much for the backward integration, and how much for the maintenance, when you are guiding 120 to 150 crore each for this year and next year?
Give and take, we do 25 odd crores of maintenance CapEx. Apart from that, everything else would be largely for a capacity enhancement, or it would be for insourcing. The exact mix would depend upon the year as well as the LOIs that is going to come.
Okay, sure. No worries, sir. So I would love to meet the management if given an opportunity. So we'll, speak to your IR.
Sure. Thank you, Dheeraj.
Okay.
Thank you very much. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Kolatkar for closing comments.
Thank you, and thank you all for your, very thoughtful questions. Yes, we understand, your key question and concerns around the margins. We have taken a good note of that. And yes, going forward, the year, as I said, the fiscal year for the country in terms of overall automotive industry, I think will still be good. Yes, the coming year, which is 23-24, there will be a likely backlash from what is happening in the global marketplace. So we have to be a little cautious about 23-24 in terms of the volumes. But again, having said that, I think overall economy and the country is in good shape. So we'll still be definitely far better than the rest of the globe. So look forward to meeting you all again in the next call. And thank you once again for all your questions. Thank you. Bye-bye.
Thank you, Mr. Kolatkar and members of the management team. Ladies and gentlemen, on behalf of Gabriel India Limited, that concludes this conference call. Thank you for joining us. You may now disconnect your lines.